The invasion of Ukraine by Russia adds to the near-term growth risks for the global economy and will keep inflation high for longer. Uncertainty is high, but equity markets are oversold and should recover if tensions ease in coming months. Global growth is likely to be slower in 2022, but we think it will still be above trend. Hi, I'm Andrew Pease and I'm the Global Head of Investment Strategy. Welcome to the second quarter update of our 2022 Global Market Outlook. Russia's invasion of Ukraine creates risks for markets in the near term, but it also casts a shadow over the longer term outlook. The immediate threat comes from high energy prices, rising food prices, and disrupted supply chains. The longer term issues are a new Cold War between Russia and the West, increased military spending, and a further blow to globalization. The war is a defining moment for Europe, which now needs to unwind decades of Russian energy dependence, accelerate their sustainable energy transition, and rebuild their military capability. Markets had plenty to worry about before the invasion. This included the start of rate hikes by the United States Federal Reserve, inflation fears, and concerns about China's economy. Our theme for 2022 before the invasion was the Great Moderation. We expected global growth to moderate from the post-lockdown surge in 2021, but remain above trend. The consequences of the invasion are lower global growth, with Europe taking the largest hit, and higher inflation. Even so, we think global growth should still be above trend this year, provided hostilities ease and global energy prices stabilize. Above trend growth should support equities over bonds and cash, but the conflict has created significant uncertainty, which means more market volatility. Even if hostilities subside over the next few months, we think that Russia's invasion of Ukraine has three significant longer-term implications. The first is less globalization. The backlash against globalization started with the financial crisis in 2008. It gained pace with former US President Donald Trump's trade wars and was delivered a further blow by the COVID-19 pandemic. The risk to global supply chains caused by the invasion will trigger a further decline in global trade as a share of GDP. Less globalization means less global competition, less productivity gains, more inflationary pressure, and lower global growth. The second is that geopolitical risk has increased. The invasion has highlighted global political fault lines. Russia's No Limits partnership with China puts the focus on the US-China relationship. The severity of the economic sanctions on Russia will likely deter China from pursuing its claims over Taiwan anytime soon, but ongoing tensions will be a continuing watchpoint. The third is an accelerated clean energy transition. If anything positive can come from the Ukrainian tragedy, it may be an extra impetus to the move away from fossil fuel dependence. The European Union has announced plans to be independent from Russian fossil fuels well before 2030, and they will use wind and solar as well as energy-saving measures to achieve that goal. China, in turn, can lower its dependency on coal by using cleaner natural gas from Russia, which it no doubt will be able to get at a discount. Let's turn to our asset class preferences. Our cycle, value and sentiment investment decision-making process still scores US equities as expensive. The United Kingdom and emerging markets are at fair value, and Europe is only marginally expensive after the recent market falls. The hard-to-value Japanese market also scores as slightly expensive. The Russia-Ukraine war has increased the risk and uncertainty around the cycle outlook. On balance, we still expect the cycle to be supportive for global equities and remain a headwind for government bonds. Russia-Ukraine has added to the challenges facing emerging markets. China's economy was already under pressure from the real estate downturn. This has been made worse by the shutdown of major cities due to the zero-tolerance COVID-19 policy and by higher energy and commodity prices from the war in Ukraine. Emerging markets also face the difficulties of Fed tightening, a stronger US dollar, and rising food and energy prices. Emerging markets could stage a turnaround if, as seems likely, China undertakes significant stimulus and commodity prices decline. For now, however, a neutral stance is warranted. The US dollar has made gains this year on Fed hawkishness and the dollar's safe haven appeal during times of global conflict. Currencies such as the euro and the yen are now significantly undervalued on a longer-term basis. The uncertainties around the outlook are large, but there is a case for US dollar weakness later in the year if hostilities in Ukraine start to ease and the Fed becomes less hawkish as inflation pressures lessen. Dollar weakness should support the performance of non-US equity markets and will help offset some of the headwinds facing emerging markets. Our sentiment measures for equity markets are firmly oversold, but not yet at the level of panic reached in late 2018 and early 2020. The cycle uncertainty means we're looking for clearer signs of market panic before recommending a risk-on stance. The Russian invasion is first and foremost a humanitarian catastrophe, but it's also made the outlook for markets and economies more complex. We think the global economy can still manage above-trend growth this year, but this depends on hostilities easing over the next couple of months. This outlook favours maintaining a positive view on equities over bonds. Thanks for watching, take care, and we'll talk to you again soon.